At NCS, we solve technology problems where others can't. Challenge us. Search NCS Australia.
The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today to ring in another year, he's relaxed, he's rejuvenated and he's red hot and raring to go. It's Anthony Macdonald. How are you, Anthony?
Let's reunite the Roosters, James. Ready to raise the roof.
Fantastic. This week, we jump straight into the big two moves of the week in markets, interest rates and tech stocks. We take a question on who should oversee government spending, and we get ready for the busiest time of the corporate year, reporting season. But first, Anthony, well, we've been off the airwaves for 6 weeks. It's probably a bit long, really.
Yeah, it was.
I've missed you. And a lot has happened in that time, we must say. We've had big deals, big geopolitical plays, big market moves, and the big cheese, Donald Trump, has kept us all entertained. It was anything but a sleepy January for Australian investors. So let's quickly pick up 5 things that we reckon listeners need to be on top of. We'll look at what's happened and where it's going. And I want to start with you in the world of deals. We've actually got a bit of breaking news here on Friday morning. Rio Tinto, it launched a big bid for rival Glencore at the start of January to create the world's biggest miner. But Anthony, it's all fallen apart.
Died overnight, James. Rio had 30 days to put up an offer, didn't do it. Plenty of talks, due diligence, all that sort of stuff, but just didn't get there. So it's off for now. Rio can't go back for another 6 months under UK laws. What's going on there? I reckon it's hoping that Glencore sort of rethinks things, maybe comes back to it and gets a bit more serious on price.
Yep.
Rio, I don't think was too happy with Glencore's price expectations. Glencore wasn't too happy with Rio, so they can go away, think about things for a bit and see what happens. What do you think?
I think you're right. Both companies are walking away from this. I don't think there's a whole lot of bad blood. They're a bit disappointed the deal didn't go ahead, but they just had a disagreement on price. I think the personal relationships are okay. The strategic sort of rationale for the deal, which is around Rio getting their hands on Glencore's copper assets, that's still in place. Don't be surprised if this one gets resurrected at some stage, Anthony, I reckon.
It wasn't the only big M&A move, James. Ryan Stokes' SGH, an American partner, Steel Dynamics, bid $13 billion for COLORBOND maker and Australia's only profitable steel maker, BlueScope Steel. BlueScope rejected it, James. Is that one dead too?
No, this one's still ticking along in the background, I think, Anthony. BlueScope Steel has run an incredibly effective, incredibly strong takeover defence. To be fair, they've had a while to plan it because Steel Dynamics has been sniffing around for 15 months and it made, I think, 4 takeover offers in that time. Mm-hmm. So BlueScope's well prepared with its defence and it's run it really well. But I think Steel Dynamics in America sees itself as the natural owner of BlueScope's big steel mill in Ohio, and it's still got a deep desire for that mill. And I think the Stokes family's SGH group really wants to get its claws into the Australian business. So I think we've got BlueScope results in a couple of weeks. I reckon the bidders will have a look at those results and see if that opens the door to another bid. Anthony, I think you're on the same wavelength here.
I mean, SGH and Steel Dynamics offered $30 a share. Clearly wasn't enough. Straight away, the market has turned to, maybe $40 a share. Usually in these situations, you see SGH and Steel Dynamics come back quickly with a much lower bid than everyone was expecting, to really smash those expectations of a big price. We haven't seen that yet, so yeah, curious to hear from SGH next week to see what's going on.
Yeah, they've got their results next week. Now, it's also been a huge time for the Federal Reserve, the central bank over in America. First, the current chairman, Jerome Powell, and the Fed were served with legal papers saying that they were being investigated and might face criminal indictment, can you believe? Mm-hmm. And then good old Donald Trump, he announced his new pick for the Fed chair, a guy called Kevin Warsh. Now, he's a former Fed official, Anthony, so he's not an unknown quantity, but what do you make of this selection?
I think the selection was probably about as conventional as it could have got from Donald Trump, which was exactly what the situation needed. I mean, this has been fantastic theatre, James. I mean, that Sunday night address by Jerome Powell revealing the investigation into the Fed, that was a bit of a lightning rod moment for a situation that had been brewing for 12 months as Donald Trump just kept abusing Powell and abusing the Fed for not dropping rates as quickly as he wanted. This sort of brought it all to a head. Trump hit back soon after by announcing the person that he'd recommended for the job, like you said, Walsh. And the market actually took some comfort in that. They're like, oh, well, like there were crazier ideas out there.
Yeah.
So it's settled down a little bit. The big question now is whether Powell sticks around beyond May when he's due to step down as chairman. Does he stay on the board? And if he does he then have the biggest say in the room still? Because, he's worked it with everyone for so long and his credibility is actually, despite Trump's niggling at him, his credibility is even more intact. So, yeah, it's still going to be fascinating.
Yeah, I loved his video. It was sort of like a combination of like those wartime addresses that a president does and a hostage video. It really had this great sort of strange vibe, which was terrific.
Still in the world of Trump, James, his speech at the World Economic Forum in Davos was really something. He teed off on Europe, he teed off on NATO, he teed off on Canada. He said the US alone could protect Greenland. I mean, it was quite a rambling speech as well. Does it have any consequences, though?
Well, it has the consequence of making us listen to an hour-long speech from Trump again. Like, this guy cannot stick to a tight 10 minutes. He's an hour man. He just loves it. And he rambles, he goes off the auto cue. It's quite a spectacle. I reckon, though, Anthony, it wasn't Trump's speech that was the most important. It was the Canadian Prime Minister, Mark Carney, who made the biggest speech at Davos. And he said the rules-based order is over. There's been a rupture. And I think everybody it was one of those moments when everybody knew exactly what Carney meant, but there was still some power in saying it like that.
Yeah.
People are working out Trump's view of the world and they're adapting to it. So in a way, Trump sort of blunders into these conferences and throws his weight around, but it's working. He's making the world adapt to him. He's not adapting to the world. It's quite impressive to watch. So I think we'll see more of that over the course of the year.
I still can't get my head around it's the same Mark Carney that was trying to buy Origin Energy for Brookfield a couple of years ago, James. He missed out on Origin and now he's gone off to run Canada. So good to see there was a second prize.
Yeah. Do you think the current Origin chairman's a chance to be our Prime Minister or something? Or maybe it doesn't work like that.
Who knows?
All right, last one, Anthony. If Donald Trump's been busy, so too has Elon Musk. He announced plans this week for his space company, SpaceX, to acquire his AI company called XAI, combining two of the world's biggest private companies and notionally threatening to take data centers to out of space. Are you a big believer in the potential for space-based data centers?
I'm still waiting on flying cars, James. My parents grew up watching the Jetsons. I mean, they'd say they're still waiting on the flying cars too. Like the way Musk talks about it, we need power for the data centers and perhaps there's not enough on Earth, need to go to space, harness all the energy up there. Whether that's even feasible or not, I have no idea. My physics knowledge caps out at equals MC squared. But I think, here we've got a couple of really tightly held Musk entities. If you're invested in either of them, you're going to be a believer in him and his vision and what he can do. So if he's jamming them together, I guess you're even more all in on Musk. So you're probably back to where he started. But whether there's going to be data centers in space, I've got no idea.
Yeah, well, your reference to E equals MC squared, Anthony, takes me back to the days of the famous Australian film Young Einstein. And Elon Musk's got a few Young Einstein characteristics, I reckon. He is all over the shop. He's everywhere all the time. He's a little bit crazy and he's great copy. So in some ways I say keep on keeping on, Elon. You're giving us something to write about.
Absolutely.
All right, Anthony, let's move to our first main topic of the week. And there's only one place we can start. Interest rates. The Reserve Bank of Australia hiked rates for the first time in more than 2 years on Tuesday, ending a rate cut cycle that spanned only 3 cuts within 6 months last year. Now, RBA Chair Michelle Bullock said it was a unanimous decision around the RBA board's table, saying 2 straight quarters of above-average inflation meant it was time to slam on the brakes. But Anthony, This really still feels like a sudden reversal from the RBA. Only a few months ago, economists were talking about rate cuts and uncertainty, and I think that the general tone from Bullock was pretty dovish. Did we blow the soft landing by accident?
I came away on Tuesday wondering whether we got sold a great furphy in the soft landing. Anyway, James, was it really ever going to be possible to bring down inflation? What would seriously tear away inflation up in the 7% region without hitting jobs? It looked like we were doing it. And for about a year, we had this beautiful scenario where inflation was slowly making its way back towards 3%. The jobs market was still tight. And we thought we got away with it. But then the reality hit home, and it turns out we can't have this sort of Goldilocks situation where all three of the economic growth, the jobs market, inflation are all going in the right direction at the right time.
Yeah.
And inflation's taken off again. So, it was 1%, 0.9% in another. You don't have to be my mate Einstein to realise that means we're running ahead of our 2.5% as the RBA is targeting.
Indeed.
And the damage was done. So the damage was done in September and December quarters, and it just felt like Tuesday. It was like the principal on the first day of school says, all right, you guys had a great summer holidays, great Christmas break, but go home and write 7 essays for your homework tonight. Back to the real world. What we're staring into, it's not all butterflies, unicorns and rainbows, James. We need to break the back of this inflation. Michelle Bullock couldn't say enough at the press conference on Tuesday. Inflation is bad for ordinary Australians. It's bad for everyone, not just people with mortgages, not people without mortgages, not boomers, not young people. It's bad for everyone.
Yeah.
And we need to stamp it out now.
But Anthony, was the soft landing worth pursuing though? The idea of what they were trying to do, to tread this narrow path where you bring inflation down without hurting unemployment too much, we sort of almost got there, didn't we? I mean, should we be too disheartened?
Yeah, we nearly got there for sure, James, but we haven't stamped out the problem, have we? So now we're raising rates again. Yeah. And how many more rate hikes are there? I'm sure we'll get to that a bit later. So done well to get to where we have, or where we were, prior to the inflation taking off again in the September and December quarters. But James, you came out swinging and said there's much more going on here than a run-of-the-mill rate rise. What does this hike say about Australia, the Australian economy, politics, and where the country's headed?
I was a bit disheartened on Tuesday, Anthony. I said this is a sign of a mediocre economy, mediocre political settings, and obviously mediocre productivity growth, a mediocre backdrop. I think what you've got to think about here is we're not raising rates because the economy is booming. Go out and ask 10 people in your contact list on your phone whether they think the economy is running hot enough to demand a rate rise. They'll tell you that it isn't.
Yeah.
And they're right. Growth is supposed to peak at 2.3% according to the RBA. Now, the long-run average since the 1960s is annual GDP growth of 3.3%. We're well under what this economy used to be capable of. But now, because we've had no productivity growth for a decade, or very low productivity growth for a decade, the economy's speed limit is that much lower. So, when the economy is just growing at 2.3%, and I guess even more concerningly, the RBA's midterm forecast is for growth of just 1.6%, then all of a sudden we're getting the inflation sweats, as one economist called it. No, that's not good enough. And when I think about it, what do we blame that on? Well, successive governments have failed us on productivity growth and reform. And, the other problem, the near-term problem at the moment is government spending's continuing to rise. Okay, that's partly the Albanese government's fault too, but I look at what's happening in Canberra at the moment with the coalition disintegrating and the National Party, splitting and all sorts of problems in the opposition, and I think, well, that's just mediocre politics as well. We're getting no opposition that's strong enough to hold the government really hard to account. So I just think this is a bit of a sign of where we're at. It doesn't feel like much in Australia is getting measurably better. It might not be getting worse, and it's still a great place to live and that sort of thing. But what the RBA is telling us is that real wages, inflation-adjusted wages, are going to fall for the next 2 years. That's not a happy story, I don't think. I don't know. Am I over catastrophizing things?
Happy New Year to you too, James. Thanks for starting us off on a real positive note.
Yes, fair point. Okay, I've got an interesting question here for you from a listener, Andrew in Victoria, Anthony. And he says, can you tell me what will be the economic signals that the cost of living crisis is over? We hear about it all the time. Politicians use the term constantly to sell policy changes. But how is it determined, and will it ever get better? It's a good question, Anthony.
Yeah, great question, Andrew. And I'm not sure if it's asked as a question or there's a bit of an observation, but there isn't an official signal that would spell the end of the cost of living crisis. I think if inflation got back to the middle of the RBA's 2 to 3% range, I know Bullock's explicitly now talking about 2.5%, that would probably be the end of the cost of living crisis. However, just because inflation gets back to 2.5%, assuming it does, it doesn't wind back what would by then have been years and years of high inflation, where prices were skyrocketing, where you've got these compounding increases of, 4, 5%, 3% a year, So, if a dozen eggs cost $5 5 years ago and they're now $7, they're not going back to $5 or $5.20 or whatever.
Exactly. Yep.
And if they're $7 and inflation's at 2%, they're going to be $7.50 before you know it.
I believe your maths.
Yeah. I need my mate Einstein again. Politically, I think it's going to be very tempting for politicians to pull out the cost of living crisis for years to come. Anytime they have anything that's populist, that's no good for the budget, that's questionable in its spending, that's arguably designed to buy votes, pull out the old cost of living crisis excuse and makes it really hard to argue against for the opposition. And I think it's for Australia's sake, the sooner we get past the cost of living crisis, this notion of it, the better, because the government, quite understandably, it flooded the economy with money in COVID. That's what it had to do at the time. And, and it got the economy through the pandemic. But we're stuck now in this situation where we've got higher than expected inflation. People are feeling like they're doing it hard, but still looking at the government to do something to look after them. Spending's still up.
Yep.
We've been a victim of our own success in a way, and we really need to rule a line under that era. But James, what matters now is what happens to interest rates in the future, right?
Yep.
We've never seen the RBA stop at just one hike. What did Bullock say about the potential for further increases? More importantly, what does your gut say?
Well, she sat on the fence, as you'd expect her to do. She's not wanting to scare the horses, but she's not wanting to provide people reassurance that rates are suddenly going to go down. So I think they're in watch and act mode.
Yeah.
But I think the tilt is probably towards more rate rises. The RBA's own inflation forecasts have inflation hitting 4.2% in the middle of the year. That's too high.
Yeah, ouch.
That's too high. So that alone says there'll have to be at least one more hike. And I think the question amongst economists now is, will there be a third hike? So I think that's not settled. There's definitely another hike coming. The betting is in May, but watch out for a hike in the second half of the year, I think. We had 3 cuts, we might get 3 hikes and we get back to where we started, which would be a little bit ironic. What's your prediction, Anthony?
Yeah, it feels like we're on this roller coaster, doesn't it? There's no just sort of like sitting and letting things settle. It's down and up, and then straight away the market will be talking about down again, and we're going around in circles here.
That's a great point, because I think Bullock made this point in her statement on Tuesday. The impact of the 75 basis points worth of the 3 rate cuts that were done last year, that still hasn't flowed through to the economy fully.
Yeah.
So the RBA is sort of like overlapping itself, or currently trying to work against what it's already done. So it will take a little while for all this to wash out. So watch out for that.
Foot on the accelerator, hand on the brake, James.
Indeed.
Let's go to our second big topic today, and it's one close to your heart, James. Software stocks have been smoked. It doesn't matter whether you look at the ASX's heroes like WiseTech and Xero, or the big global players on the NASDAQ. They've had a horror week that brought to light a horror few months, and there's no sign that bloodletting is done yet. I feel like this is something you've been waiting for, James. You've been full of warnings about AI stocks and tech and bubbles and valuations and bullish exuberance. But what was it that tipped it over this week?
It was a guy called Claude, Anthony.
Oh, yeah.
Well, it's not actually a guy. It's a product called Claude, released by one of the big AI model companies, Anthropic. Mm-hmm. Claude is like ChatGPT. It's a large language model. But Anthropic's been developing a lot more tools to go around that. So over the last 4 weeks or so, they've released this tool called Claude Code, which helps people do what's called vibe coding. If you and I had a great idea for an app, we could use Claude and not need to have any coding skills, which we don't, and come up with this app over time and a bit of trial and error and all that sort of stuff. So on Tuesday, our time, Anthropic announced a new product from Claude, a legal plugin. So this was a tool that promises to do, well, basic legal work.
Yeah, right.
Reviewing contracts, amending non-disclosure agreements, looking at templates, responding to basic queries. And this is a bit of a moment, I think, because investors looked at this and thought, hang on, there's lots of software companies that do lots of different things for lots of specific industries. But all of a sudden, within just a couple of years, Anthropic is able to release specific products for these specific sectors, basically replicating the software that's being sold already into those sectors. And they saw that news and they said, 1 + 1 = sell everything. Software companies were smoked. I mean, some of the falls were amazing. We had, Gartner, which is a big data and consulting software business in the US. It was down 21% in a single day. WiseTech and Xero, as you mentioned, they had horror days on Tuesday as well. I think they were down 7% for WiseTech, more than 10% for Xero. The magnitude of the falls were pretty big. Atlassian, which is that homegrown Australian tech company that's based in the US, I mean, it's down 70% in the last year.
Ouch.
It's been hammered this year as well. It's down 40% since the calendar turned over. But I was looking at its share price. It's now back to where it was in 2019. Uh-huh. So basically what investors are saying is, sorry, this company's made no progress in the last 7 years. That's a remarkable thing, given how much, Atlassian's changed and grown and done different things. But investors just don't want a bar of software at the moment because they think the AI disruption wave is just so strong. What's interesting, though, Anthony, is that, tech stocks were smoked. Normally a sign of a big risk-off mood in markets. Everybody's retreating to the sidelines. And yet the big share market indices like the S&P 500 in the US and our very own ASX 200, they're continuing to trade at or near record highs. So can you explain this sort of conundrum to me? Tech stocks are getting smashed, but yet the market's holding up.
Yeah, I've been scratching my head about that a bit this week as well, James. Like you said, normally you get a risk-off mood like this, tech stocks go down, the market go down, but instead what we're seeing is a lot of switching from investors. So they're selling these tech stocks and they're putting it into other more defensive pockets of the market as they see it. They're putting it into miners because commodity prices are high and miners' profits are going to be strong. They're putting them even into the banks we saw support for in Australia here this week and other defensive. So there's still money, a lot of money in equities. It's not like money is flowing out of equities as an asset class. And equities is seen to be a risky asset class. So it's not like the market as a whole has gone risk off, but it's just gone risk off around these software stocks. And the unique thing about this week, James, I thought, is you have the AI bulls and the AI bears selling for opposite reasons, but at the same time and in the same direction.
Yeah, good point.
So in one camp, you have the AI is just not as good as we thought, and it's not going to drive the productive growth as we thought, and that's why NVIDIA and Microsoft and AMDs and that have been sold off. But then on the other hand, you've got the thing that, AI is way better than we expected and needs to be slowed down. And that's why all the SaaS software companies have been sold off. So it's kind of occurring at the same time.
Yes.
Hence why I think it's bubbled over. But James, there are some pockets of concern, and we've got this new risk asset class now in listed markets, don't we? Something even further up the risk spectrum than equities, and it's been smoked this week too, right? And that's Bitcoin.
Yeah. Down
nearly 10% in the past week to its lowest level in more than a year. It was US $120,000 a coin in October, and it's now fetching not much more than US $70K, right? And that's right out there on the risk spectrum. So I think there is evidence of a risk-off mentality. We're just not seeing it normally the way we would in equities.
Yeah, I think there's a good reason for that, Anthony, and that's because there's no recession. Usually when you have a big sort of correction in markets, you need a recessionary environment. We saw that with the outbreak of COVID. We saw it with the GFC. We saw it in the .com era. We didn't have a recession in Australia, but we did have a downturn in the US. There's just no signs of that downturn in the global economy or the US economy at the moment, or the Australian economy for that matter. So I think that's really important in providing a sort of buffer. But still, I mean, there's a lot of concentration in tech stocks, which we've been talking about for 2 years. This is a mini tech wreck. There's no other way to describe it, and I think it bears watching.
So where's the AI and software story go from here, James?
I think it's going to be very hard for software companies. They're going to take a little while to regain the trust of the market. They're going to need to produce some results that show that either AI is not disrupting them as expected, or they're using AI and that's helping them grow their businesses. So that process will take a while. I mean, you look at something like Atlassian, the stock's been falling for a year. It might take another year of convincing investors that there's a turn there. And I'm just a little nervous about what we're seeing. You mentioned Bitcoin and crypto. It's getting a little disorderly in crypto. Like a lot of people have used leverage to juice their crypto bets. Given the rate Bitcoin's falling, it appears that leverage is now being unwound at quite a rapid rate. I just worry that we had a lot of retail investors, particularly in the US, who'd made stacks of cash or stacks of paper profits out of cryptocurrencies. They're now underwater. Does that take some heat, not only out of the crypto market, but out of the broader equities market? There's a bit of a cross-asset spillover, as the experts would say, Anthony. So I think that's just worth watching. One other thing worth watching that's close to your heart is IPOs. When markets like this, what does it mean for the pipeline of companies that want to float? Bankers started the year saying this was going to be a good year for IPOs, but is that already dashed, 6 weeks in?
Oh, the bankers always do, James. That's part of the gig. That's they talk up IPOs just like we get excited about governance issues and corporate drama in our jobs, James. But I mean, what's going on in markets, it really reshapes capital allocation. You can look at these things as just, short-term share price moves and whatever.
Yep.
But if you step back and think about what share prices are, and what investors are actually doing, it's allocating capital towards companies, towards sectors, towards opportunities. When you have share prices going down, it shows investors are stepping away from those things and they're not allocating capital there. And it's exactly the same in IPOs, James. When the market's like this, if you have a software company at the moment with any concerns around AI, there, you're just not going to be listing, right? If you thought your company was worth $100 at the start of the year, it would now be worth $800. Investors would want another $200 discount to list it. You'd be listing at $600. Meanwhile, your existing investors would be like, why are we listing now? I'd have to take a massive write down on my beautiful protected private valuation. So it doesn't make sense for them. So it just doesn't happen. So I think we can forget about the software IPOs at least for a while, James. But that doesn't mean the IPOs are off full stop. I think, anything that's in the defensive part of the market, anything in commodities, anything where you see the money flowing in the secondary market, there's going to be ample IPO opportunities there. And we've got a couple lining up in Australia. We've got the pet goods retailer Green Cross and the furniture group Super A-Mart. Expect them to be out soon after reporting season. There's a whole other backlog of companies to come after that. So, I mean, I think sitting here at the start of this year, it definitely feels like it's going to be busier in IPOs this year than it did last year or the year before, or even the year before that. Yeah. Which is good. It's good to see new companies lining up for the ASX, but in software, it's going to be hard.
Yeah. I just also watch private equity. I mean, this is the spillover effect. So I'd be watching private equity and private credit here too. The global private equity sector and the global private credit sector, about 20% of their portfolios are in software. So there's a chance that this big software sell-off sparks some drama in private equity land and private credit land. That's the sort of problem. You get these spillovers. It's not just contained to publicly listed software companies. It spills over into private equity, spills over into private credit, spills over into venture capital, spills over into crypto. Just watch it. I think that's the danger sign that we're looking for. All right, Anthony, we'll come back after the break. It's back. Reporting season, our favourite time of the year. Back with a preview in just a minute. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. Okay, Anthony, we love profit season here on the Chanticleer podcast.
Sure do.
It starts with a really big one on Wednesday, I reckon, Commonwealth Bank. And then we've got a few others, JB Hi-Fi and car sales on Monday. CSL's also on Wednesday. The insurer IAG and the energy giant Origin are on Thursday. And then a quarterly update from Westpac on Friday. This is a pretty good start. I think CBA is the one everyone's going to watch, right, Anthony?
Absolutely, yeah. Strong start for reporting season next week. Commonwealth Bank, always a flagship, sets the tone for pretty much everyone else.
Exactly. We've also got Macquarie giving their annual operational briefing on Tuesday. It's a sort of once a year, explainer on what's happening inside Macquarie, which has been under a bit of pressure, Anthony, in the last 12 months. What do you think the message is going to be this Tuesday?
Well, it's a little bit of a secret. Macquarie's yet to tell analysts exactly who's appearing and when and everything like that. All we know is it's going to be about Australia and New Zealand, so I expect it'll be about Macquarie's operations here. We'll go through the retail bank, then we'll look at Macquarie Capital, the investment banking side, asset management, the commodities unit as well. A bit of a focus on Australia. I mean, you must think that means Macquarie thinks that's the good story to sell at the moment, that people are, buying Australia, want to be invested here, which is, good for the country. But yeah, we'll have to wait and see exactly who shows up.
Oh, I'd love to get a little bit more info on that bank of theirs, which is going gangbusters. And then, Anthony, on Friday night, we've got US inflation, which there's a really open question. As in Australia, where inflation's kicking back up, the US economy is running pretty hot. Could we see inflation kick back up there? Could poor old Kevin Walsh, the new Fed chair, could he even have to raise rates at some stage?
The economists all seem pretty comfortable that inflation's under control there because they've got the productivity, James, allegedly from the AI. So their outlook's kind of different to ours. They're talking about 2 rate cuts later this year when Walsh comes in, which is good, although it is notable that there's a lot of talk about affordability again over there.
Yeah.
Which, going back to our cost of living crisis question earlier, it's not off the agenda, definitely in terms of the politics anyway.
No, the beef prices in America are surging, Anthony. So, watch out for that. All right, Anthony, we do love questions here on the Chanticleer podcast. This week, our question is from Mahan from Sydney. And if you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it to us. There's also the widget on Chanticleer articles at afr.com, which lets you ask questions. So, Mahan, who's an economics student at the University of Sydney, take it away.
With inflation in Australia currently running hotter than expected, and discretionary fiscal stimulus often cited as a contributor, especially this time around, I wanted to ask this. Why don't we have an independent authority that sets the aggregate fiscal stance of government, meaning they set the overall proportion of taxation and government spending without determining what is taxed or where spending occurs or how much of each? Similar to how the RBA or most central banks set interest rates, this body would only determine by how much fiscal policy should be expansionary or contractionary, making sure to use fiscal multipliers that is weighted based on each type of policy proposed by the elected government. The framework could also include explicit emergency carve-outs for wars, pandemics, or financial crises where fiscal discretion is temporarily restored. Given these constraints, why has no country implemented this type of independent fiscal stance authority?
Good to see you, Sid, spitting out ideas.
Yeah.
James, good question, Mahan. I think the thing is, though, you got to think about what we're actually voting for when we go to elections and we vote for these politicians. And a big part of what we're voting for is their fiscal policy stance, what we think they're going to do for the budget. So if all of a sudden you've got an independent authority overseeing whether it's going to be expansionary or contractionary fiscal policy, I mean, should we be voting actually on the independent authority rather than the politicians themselves? Because, it might just leave the politicians to allocate the money, and pursue the legislative changes and the social changes rather than the actual economic policy themselves. I mean, I personally think it's very important that we get to vote on the political parties and the people based on their economic policies and what we think they're going to do with the budget, including whether it's expansionary or contractionary. I think that's that's incredibly important part of the democracy. What do you think, James?
Yeah, I think that's right. We vote for governments to govern, and a big part of governing is managing fiscal policy. Also, to think about the sort of practical challenges with an advisory panel like this. Who's on the advisory panel? Are you on it for life? Is there set terms? And who would actually appoint people to the advisory panel? Of course, it would be the government. And so you would just get, a quasi-political body overseeing an actual political body. I get the theory. I like the idea of independence, but I think it's a democratic process. We get what we vote for. And I think that's really important in the way that fiscal policy is run. All right, Anthony, great to be back. Can't wait to launch into profit reporting season next week with some absolutely giant names to look at.
Sure is, James. It's always the best time of year, results season, so good to see it starting on Monday.
Yeah, absolutely. Thanks for listening. We'll talk to you next week. If you like the podcast, send it to a friend as it helps others find us. And don't forget to follow wherever you get your podcasts so you'll never miss an episode. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people. Chanticleer was hosted by me, James Thomson and Anthony Macdonald. It was produced by Mandy Corlin and our theme is by Alex Gow. Head of Audio is Alex Gow and Head of Premium Content is Fiona Buffini.
The Australian Financial Review.